Hey everyone, welcome to Bald Guy Money. I am Bald Guy, and in last week's video, you may remember that I was talking about how we should expect a period of sideways price action or price consolidation as computers around the world were programmed to sell paper silver just below $30 an ounce. And although we pulled back a little more than I had expected, we are seeing that price consolidation I talked about as short-term investors are getting shaken out of their paper positions and we wait for the next catalyst, the next reason for gold and silver to continue their journeys upward. And if you watched last week's video, you will probably remember what I said the next catalyst I expected to see would be. But if you didn't catch it, here's a clip from that video. What do I think will be the catalyst for silver's big move up? When it will reach a point where my tools indicate that the price of silver is expensive and that I might want to consider initiating a sale to purchase real estate? Well, that catalyst is the coming turmoil I expect in banking. Okay, so here we are just 1 week later, and we have just seen the first US bank failure of 2024. And admittedly, it's a small one. Republic First Bank, there's probably not much to worry about as the cost to cover this failure is less than $1 billion. And we all know $1 billion is not what it used to be. Even $1 trillion isn't what it used to be. But this development is just a small piece of evidence in the growing case that proves what we've known for a long time now. And that is the fact that US banks are walking on shaky ground. It's why the US Federal Reserve needed its sneaky program of money printing in 2023 to save some of these banks, but it also means, due to the interconnectedness of global banking, that banks around the world today are also at risk, and that's the lesson we carry with us from the 2008 financial crisis. Now, on the flip side of that shakiness, you have metals, so gold and silver, because I don't stack any other metals other than gold and silver, and we're in the early days of a bull market for gold and silver. I mean, I remember when we used to talk about gold as a $12 trillion market. Looking at it today, nearing $16 trillion in total market value, it's added about $3.8 trillion in total market value over the last couple years, which is more than the total value of the number 2 asset on the list of top 10 assets by market cap, which is Microsoft, at a current total value of $3 trillion. And when we see moves like that, the question has to be asked, is the recent momentum we're seeing in the prices of gold and silver, is that a sign that people with knowledge of what's really happening in the background, is that a sign that they are positioning themselves in advance for what's coming? So in this video, I want to discuss how serious this problem is, and I will talk about if it's getting better or worse. And before I move on to the viewer question for this video, I want to show you all how this will influence the prices of gold and silver moving forward. And for that example, you are going to see gold and silver price development during times of banking stability versus times of banking crisis. And I think it will really open your eyes as to where we are in the current cycle today for gold and silver versus where we could be very soon. Now, just before we get into it, if you're in the USA and want to buy gold or silver at a great price from a dealer that you can trust, please check out channel partner Pimbex at pimbex.com. They have an amazing assortment of the best metals for stacking. What you're seeing right here is just a small sample of what they have to offer. And for those of you who want to get some gold and silver in your IRA, remember that they can help you. Call them for a free consultation at the number on the screen to find out how. Just please tell them you came from the Bald Guy Money channel. So, jumping into it as it stands today, the FDIC, so the Federal Deposit Insurance Corporation, which is the agency that exists to back up bank deposits and to maintain stability and confidence in the US financial system, they have just under, as you can see here, $122 billion in their deposit insurance fund. And we can even probably subtract the roughly $667 million they just used to save Republic First Bank. So for all intents and purposes, let's say that they have about $121 billion in their deposit insurance fund. Now, I'd say that's a pretty impressive number. $121 billion is a lot of money after all. And clearly this latest bank failure isn't going to bring down the financial system or the FDIC because it's a relatively small player and it's nothing compared to the size of some of the banks we saw go under in 2023. But if we weigh that fund versus the total underwater assets that U.S. banks are currently holding onto, and here I'm referring to the U.S. government bonds that banks purchased with depositor money, so your money for all my viewers who have bank accounts in the United States, that was your money they used to purchase those U.S. bonds in the years of near zero interest rates. You can see that those banks are sitting on unrealized losses of about $675 billion US dollars. And this is data coming straight from the FDIC itself. It's not some wacko internet website. This is straight from the FDIC. So it's clearly a situation that they're aware of. And what this means is their entire fund, the one set up to protect U.S. bank deposits and maintain confidence in the financial system, only covers about 18% of all the unrealized losses that U.S. banks are currently carrying on their balance sheets. So in value terms, if banks representing 20% of that total unrealized loss go bust, go broke, go bankrupt, not only will those banks go down, taking all of the depositors' savings with them, but it will take the FDIC, in theory, down with them. Now, you could make an argument against that, and you could say, yes, but bank customers are earning money all the time, and new deposits are flowing into banks on a weekly or monthly basis, and I agree, that argument could be made. But with inflation making an impressive but predictable comeback, the amount of money Americans are able to save is going down. In fact, according to the latest Federal Reserve data, Americans are only able to save about 3.2 cents of every $1 they earn. And I'd say many Americans are lucky if they're able to save even that much, as many are going deeper in debt to cover the basic costs of living. And this is obviously impacting the amount of deposits that are being held at banks right now as people burn through their cash savings to pay credit card bills, mortgages, to make car payments. In fact, bank deposits are shrinking faster than any period on this chart, which goes all the way back to the 2008 financial crisis. And this is being made worse by the fact that full-time jobs continue to disappear and are being replaced by lower-paying part-time jobs. The same part-time jobs many people in the mainstream media and many politicians will tell you that are proof that the economy and labor market are strong, while ignoring the basic fact that in a strong economy, people usually save more money, not less money. And because of what's happening in 2023, the U.S. Federal Reserve created a program called the BTFP, or Bank Term Funding Program. Now, I know many of you are probably familiar with that program, but for those of you who aren't, this program allowed the Federal Reserve to inject roughly $400 billion of newly created digital ones and zeros, US dollars, into the banking system to stop a repeat of the 2008 financial crisis. And that brought the total number of at-risk of failure banks down to a level they felt could be managed by the FDIC, where total assets held by leftover at-risk banks went from more than 100% of the FDIC's total insurance fund down to about 50% of the insurance fund. And by the way, this was also helped along by sweet deals to private banks like JP Morgan to incentivize them to take over some of the failing banks using what ultimately added up to printed money and taxpayer money. And this was brokered all by the Federal Reserve of the United States in tandem with the Treasury Department. So we're talking about Jerome Powell and Janet Yellen. But that program is over now, and as I said last week, it's only a matter of time until we start to see these problems start to come to the surface again. Republic First Bank, although a small player, is just one of many banks teetering on the edge of solvency, with yields on Treasury bonds now approaching 5%. And as those yields move up, and here you're looking at the 20-year US bond yield, which is up about 17% so far in 2024, as these yields move up further on more bad inflation data and the increased risk of higher interest rates for longer, the pressure on these banks continues to go up, which means either the banks are left to fail, which will cause a rush into gold and silver, or the US Federal Reserve will decide to cut interest rates sooner despite inflation moving back up again, which will also cause a rush of money back into gold and silver. So I hope you all see exactly how this is working, because it's something I've been talking about since December 23rd, 2022, and you can go back and find that video. It was only a 5-minute video where I said the Federal Reserve is backed into a corner and that the environment favored metals both ways. And it's why I have been so consistent with my message here, because people who really understand the market could see this coming. And to answer my question from the start of the video as to whether the current run-up in metals is a sign that smart people are positioning themselves for what's to come, I'd say the answer to that question is obviously yes. Smart people have been positioning themselves for a few years now in anticipation of this very situation. Because if we look at how metals have performed in years of instability in the banking sector versus the years when everybody was convinced that everything was okay and nothing could go wrong, you can clearly see that both gold and silver still have the potential to make big moves from here. Yes, we are ripping to the upside. Versus the average closing price of last year, we're up 22% on gold and 16% on silver. But those gains have the potential to be dwarfed, as we saw both gold and silver basically double in price during the 5 years of global economic weakness following the 2008 crisis. And with central banks wise to what the US Fed's next move is, which is printing more money to save the day, this means monetization of US debt is becoming very real. And that gives the US government the green light to spend as much as it wants while the Federal Reserve buys the debt with freshly printed money. And in this scenario, I just don't see metals doing poorly. All I see is a situation where the value of my hard-earned money is protected in gold and silver, and maybe even a little bit better than protected, as more people abandon their currencies, realizing what's going on in the financial markets, realizing that US debt is being monetized, so basically money is just being printed at an out-of-control rate, and they move in, more money moves in, to the safety of gold and silver. And if you don't believe me on that point of monetizing debt, because it's something we've heard a lot of over the years, but we're really starting to see it come to a head right now. And if you don't believe me on the harm it does to currencies and how metals actually benefit from it, here's what Ray Dalio has to say on the topic.
Indicators of when a fiat currency is going to decline into collapse is when those who are holding its debt sell the debt, and the government, central bank, has to print money to buy that debt in large size while that's going down. Those are the most important indicators. So that you can see it, again, I want to repeat, selling the debt so that there's a big supply-demand imbalance, and the central bank having to come in there and buy the debt that no one else will buy in large quantity, so that then there's a currency devaluation. You have those three things aligned, the currency devaluation going down at the same time as those other two things are happening, and that's been a classic. It's like a bank run. They come to the bank, there's not enough money in the bank, and so they have to make up the difference by the printing of money.
Okay, so with that covered, it's time to move on to this video's viewer question. Remember, you can submit your question in the comments section of this video right now. I pick one comment to appear in every one of my videos, one question I should say, so you never know, yours might be the next one to be selected. But if you don't want to wait for me to select your question to appear in one of my videos and you want your question answered now, remember, you can get direct access to me by joining my Patreon. You get access to all of my additional video content, as well as the Patreon Discord, where I'm active every single day, chatting with the patrons, sharing my opinions on different topics, as well as breaking news and obviously the occasional funny meme. We do share some funny stuff in there. It's not all serious. If you want to join, link to join is in the video description and pinned comment. But getting to this question, it comes from Liza R. New, and Liza asked, is ETF or ETC physical silver safe? Or if there is a squeeze on delivery for physical silver, is it best to take it in the physical form? And that's a great question because a lot of people say, I don't want to pay the premiums for physical silver. I would rather hold the ETF instead. And for people looking to make temporary trades, I say, hey, more power to you. Here is the SLV iShares Silver Trust. You can see one share is currently selling for $24.89. So it's actually at a discount versus the actual spot price of silver. And if you want to gamble on the price of silver over the next few days, I'd say there's no reason not to use this ETF as a vehicle for that. For short-term price speculation, why not? But if you're concerned about the things that I'm concerned about, which is the stability and value of the currency that you use, whether that's the American dollar, whether it's the euro, whether it's the British pound sterling, whether it's the Australian dollar, the Canadian dollar, whatever currency it is you're using, if you're concerned about the stability and the value of that currency, as well as the stability of the financial system at large, then I'd say owning physical is the best option. Because if it does happen that supply gets tightly squeezed, one of the main reasons could be that the dollar or the euro or whatever currency it is you're using is losing value rapidly. And when it comes time to settle your contract with these ETFs, you'll find that they'll settle you with whatever they owe you in that devaluing fiat currency, and they'll keep the valuable metals all to themselves, and that applies to gold ETFs too. So Liza, in my opinion, the ultimate form of protection is the physical stuff itself. That's why I often keep some with me right here on the table while I'm making these videos, so you can see that I walk the walk, that I don't just talk the talk. With that said, that's it for this video. I thank you all for watching. Please remember, we're a growing community, and to keep this community growing, I kindly ask you to like this video, share it with people you think need to see it, and please remember to subscribe to be informed about more content that I'm putting out. Until the next time we see each other, everybody, as I always end my videos, I will say take care of yourselves and take care of each other. See you in the next one. Goodbye.